I'm Rachel Horgan. Join me each episode as I sit down with a guest co-host covering the latest business stories in the Seattle area. We'll read the news so you don't have to. This is The Weekly. Hey everybody, I'm here at Columbia Tower Club. I'm at Top of the Tower Studios. They've been nice enough to let me record here, and I'm really excited about today's episode. It's going to be called a Mid-Year Economic Outlook. I did this last year with Skylar Olson. She was the chief economist for Zillow. And I have a new guest this year, and that's Matthew Gardner, Principal and Chief Economist for Gardner Economics. Hi.
Hello. It's very rare you actually see somebody saying it's fun and economics in the same sentence. So, no, great to be here.
So true. Yeah, and you were the former chief economist for Windermere, so you have a long history.
A very long one, yes. It's actually here you had Skylar here last time. Skylar and I are great friends. Very clever and nice lady.
She is. I'm not surprised. So we met actually when I was working at PSBJ and I was booking. We had an event every January about economic outlook, and I booked either you or Skylar. You guys kind of went every other year. And I will say, not every economist is engaging on stage, and you both were so good. So
thank you.
I'm glad you agreed to do this with me. So yeah, this episode is going to be just kind of talking about where is the economy at in the mid-year. Matthew obviously has a history with housing, so we're going to focus probably a lot on that, but we'll touch on a couple other topics. And yeah, we'll give you some advice on how to approach spending. So you ready to just jump into it?
Bring it on.
All right. So give us a big picture, overall take on the U.S. economy, where it stands, and were you right in January with those predictions?
It's always fun when you ask an economist to look back on what he said before. But to answer the question, actually, I have to say it. Yes, I was right. I think so many people, and actually not just in the last 6 months, for the last almost 2 years, have been calling for a recession. And I just didn't see it coming. So I said, well, no, I'm not there. And we obviously haven't had one. We did have one negative quarter of growth in the last quarter, but that does not a recession make. Right? So I think the bottom line where we stand today is, one, no recession, but there's a lot of caution. There's a lot of caution because of decisions, announcements being made by the federal government, by the administration. And they took an economist plodding along, doing okay, and threw a whole bunch of stuff at it. So I think it's that uncertainty that we see today, which is not going to lead to a contraction, but certainly a fairly significant slowdown.
Okay, so we're not in a recession, but the uncertainty could lead us to some downturns, but it's not happening at the moment.
No, we've seen a couple of different things, which I know we're going to get to in a while, and many it's obviously revolves around tariffs. Over and above that, there's certain geopolitical uncertainties, and ultimately what happens is, what do we do as consumers when we're not sure? Well, we freeze in place, right? We do nothing. And that's not a good thing for the US economy. I think there's all that uncertainty right now, especially around tariffs and the potential for inflation to start taking off again.
Yeah, absolutely. We freeze. So what key indicators are you watching right now? And, you kind of mentioned a little bit of what how you feel the economy is, but what are you looking at? Housing prices? What is it?
Yeah, there's lots of different things. So start out again, I mentioned tariffs, and we'll probably hear that word used a lot today. We had the latest inflation numbers came out, and they were actually quite a surprise. It didn't demonstrate any sort of kind of systemic push in terms of inflation, given it was numbers that actually included the first full month of tariffs. That's a bit surprising. Now, you could argue very easily that, businesses are actually sucking it up themselves, but I think it's too early to call that. So I'm actually going to be looking at inflation as we go forward. I think companies certainly will try and absorb some of the shock, but I think they also did some pre-buying and a few other things as well. So one of the biggest worries is, are we going to see inflation start taking off again? And I would say that is probable rather than possible. So it is likely, but certainly not guaranteed. The impacts of that come to the labor market as well. And they come in several ways. And again, businesses, when they're uncertain, what do? They freeze, which means what? They don't hire more people. And they do what they called increased productivity, meaning no help, work harder.
Yeah.
And that's where we're at right now. And again, we've got a massive slowdown in terms of overall employment. And so employment levels, yes, we're increasing every month, but looking at the 3-month average and revisions, it's really slowed down fairly significantly. And the other part of that in the labor market is immigration, and again, goes back to federal policies. We've actually seen a decline the last couple of months, the working age population of immigrants in America, and that's fallen off quite dramatically. If that continues, that will be a problem because that's actually going to push prices up higher, potentially. Wages are doing pretty well, which is kind of interesting to see. Again, given the fact we are spenders,
Right.
we're about, just shy of 4% year on year. Hasn't been impacted by tariffs yet, but again, a bit too early to call. And finally, the unemployment rate. Still pretty good. I mean, it did notch up if you look at the third decimal point as kind of geeks like I look at. Yeah. But in general, it's okay. The U6 actually is a broader look at unemployment, 7.8%. Okay. High school graduates, without a college degree, that has increased about 4.5%, but it's notoriously volatile. So in all, glass half full, we're doing okay. But I think across the board, some fairly tangible slowdowns, but not contraction, just a slowing overall, which is no big surprise.
Yeah. Okay. We're going to kind of dive deeper into some of those things that you mentioned. I want to start with the Fed. So how do you currently see their policy? Are they doing enough? And then if you want to talk about interest rates as well.
Sure. In terms of policy, I think obviously everyone wants lower interest rates.
Of course.
And we've done that. Why? We've been through, quite frankly, 25 years of historically low interest rates that we've become used to. Mm-hmm. And we don't want it to change. Obviously it has, and certainly the Fed is being beaten up royally for not lowering rates sooner. I think they're being smart. Mm-hmm. I think what we're looking at is a situation where the voting members of the Fed are saying, you might hear this a lot. In fact, you do. They're saying they're going to be data dependent. And what does that mean? It means they're just going to wait and see. Because the last thing they want to do is lower rates too quickly and then realize, we've got to raise them again. Mm-hmm. And so I think they're just being very cautious. But given the inflation numbers we saw this month, I'd say we are almost not guaranteed, but probably 70-75% likelihood we'll see the first cut in the Fed funds rate in September. Possibly we'll see one more cut before the end of the year. Beyond that, I think that, again, it's kind of a geeky economic person thing because I'd rather hope that Chair Powell acts more like the former Chair Volcker and less like way former Chair Arthur Burns. What does that mean? So previous Fed chairs, Burns was Fed chair under Nixon, was bullied to drop interest rates way back when.
Okay.
And he did, and that was not a good thing. However, Volcker said, he stood up actually to Reagan and to Carter and said, no, we're not going to do this, which was the best thing to do. So I think the Fed independence is something which Jerome Powell is continuing to espouse, continue to walk down that path. He believes accurately he can't get fired. So I think that they are just going to wait. They're going to ignore the machinations coming out of the Oval Office and just wait and see before they start lowering rates. But I think ultimately they will.
Okay, I'm writing that down. September, I'm going to check and see what happens.
Okay.
So you mentioned the tariffs a little bit, and we obviously have to talk about it. But how do you think? Do you want to go into a little more detail of how that's affecting the economy right now?
The biggest big concern, obviously, food and energy, which are very volatile, and they tend to be taken out when you look at the core rate of inflation. And it goes back to what I mentioned a bit earlier on today, which was, it's the first full month, but I'm just waiting because I think it's going to take some time for businesses to actually be forced to start raising prices. Now, if they do, the concern for the Fed then is, what do they have to do? They actually have to raise interest rates, not lower them. And it's only when you see, because the Fed have what's called a dual mandate, which is price stability, stable inflation, and full employment. And so, which is good, but they can actually contradict each other.
Right.
So if all of a sudden employment starts continuing to drop, well, then lowering rates is the right thing to do.
People can't afford
exactly.
things, yeah.
But at the same time, if inflation goes up, then raising rates is what they should do. So, they're really kind of stuck between a rock and a hard spot in certain respects. The other thing when it comes to the Fed, and not so much tariffs, is everyone looks at the Fed for mortgage rates. They do not direct mortgage rates. End of story. They've got one lending rate, it's the overnight lending rate between banks, actually. But it has implications further on the yield curve into where treasuries are. If there's a bad thing I can say about the Fed is that when they lowered rates, we remember this time when we saw sub 3% mortgages, it's because the Fed kept rates artificially low for 2 years, and they should have stopped after a year. So I think there are some consequences there, which we'll probably get to. But overall, when it comes to tariffs, the big question, quite frankly, is what really is going to happen? Because statements made by the administration seem to have a half-life of 2.5 seconds.
Right.
So they change their minds remarkably quickly. They say they're not going to. No one believes it. So right now, and it is. So therefore, it is that uncertainty, which is really, quite frankly, holding a lot of companies back.
Yeah, that makes sense. Yeah, it's one thing to say something, another thing to actually implement the policy. Okay, let's dive into housing a little bit. So you posted on LinkedIn about new data on affordability in Washington. We hear this a lot. I just moderated a panel on the affordability of housing in Washington. What were some of your findings from that?
It's ugly.
Cool.
And there you go. End of story.
Thanks for coming.
Mic drop and I'm out. Well, thank you for noticing that. My affordability index. So what I do is create an index which looks at the ability for a household making median income to afford a medium-priced home in that county, in a single-family home at that, excluding new construction. And here's the problem. It's very, very hard. And we all know that. I make certain assumptions if you think about all buyers at 20% down. But here, there's only 3 affordable counties.
What are the 3, do you know?
Oh, yeah, sure. Lincoln, Garfield, and Columbia. I will guarantee probably half of your listeners don't even know where those places are.
Eastern Washington?
Eastern Washington, Southeast Washington, actually. So, yeah, that's up from 2 a year ago. Garfield kind of got added to it. But they're very small markets, but it is a big problem. But the bigger problem actually is for first-time buyers. And first-time buyers, I assume that a few different things. They have a lower down payment. Obviously, you've got mortgage insurance, which they have to do as well. There isn't one county in the state of Washington that's technically affordable to a first-time buyer.
That is, I guess I'm not surprised, but it's, I don't know, shocking to kind of hear it.
The last time we saw one, Lincoln County back in 2022, and I think it was just for a quarter. But in fact, over the past decade, there are 11 counties out of 39 counties in the state that actually went through a quarter of being technically not being affordable. So to a first-time buyer, and that's not a good thing when you're looking at over 10 years I'm sorry if I'm under these certain situations in terms of income and home price, I cannot afford to get my foot on the first rung of the housing ladder. That is a big, big concern for me in lots of respects.
Yeah, I know you're not in, building the houses and selling in real estate. You're looking at the numbers, but do you have some thoughts on what would need to change to make things more affordable?
Oh, lots of things. But the biggest thing, and actually the easiest thing, most obvious thing is supply. If you think about it, to find an equilibrium is kind of Econ 101, right? If you can match up supply and demand, you've got in equilibrium, that's a good place to be. But we're not doing that. And we're not doing it because we're not building enough. Why aren't we building enough? Well, quite frankly, we've run out of land. And you can say, well, that applies to Seattle, but it doesn't apply to Kittitas County or Yakima County. Actually, it does. And why? Because we have urban growth boundaries. The Growth Management Act, 1990, said where we could and where we could not build across the entire state. So land constraints, and therefore that has pushed up the price of land. Beyond that, construction costs. Well,
I've heard that.
Then think tariffs. The price of aluminum. Why is aluminum important? Windows. Lumber. We still have the Canadian softwood lumber tariff. Copper, steel. All these things. Gypsum. It's all gone up significantly since we came out of COVID, not just because of tariffs. So land's expensive. Construction material costs are expensive. Labor costs? Yes.
Yep.
Why no one's getting into the trades? And so if you look at that, does that push the price up? There are fewer people, and also overlay that with immigration policies, because over 30% of construction labor is actually immigrant labor. That, again, is going to push it up. And finally is regulatory burden.
Yeah, there's going to be a lot of, like one issue can cause a lot of different problems. So,
sure.
Yeah.
So if you think about all of it, and what would a builder do? He knows, he sees the demand, he wants to build housing. That's what he's been put on the planet to do. So he'll take those 4 cost centers, right? Land, labor, materials, regulatory burden, put a bit of profit on. And by the way, his borrowing costs are far higher now than they were. And it'll spit out a number that you have to sell the home for that makes sense. But if that number is $1 million, but the price that people can afford to pay is $600,000, are they going to build it? No, they won't.
Right. Do you know what the median price of the home is?
In Washington State for a single-family home, about $660,000 in the state.
For a house, for the state. Do you know Seattle or King County?
King County, yeah, it's just shy of $1 million. It was. Sale price last year was just shy of $1 million.
That's what I thought. That's what I remember from the panel. I thought it was like 900 and something.
951,000.
Okay.
So,
yeah. That's interesting.
Yeah, it's almost $1 million. We're not talking, again, that's the entire county, not just Hunts Point and Medina, right? So it's in King County, it's almost $1 million. very hard for a first-time buyer.
And that's why I'm renting. What's your opinion on House Bill 1110? I just heard about it when I was researching you to interview you. What do you think about it? Tell us what it is and what do you think about it?
Okay, House Bill 1110. Full disclosure, I was part in actually part of creating it because I sit on the Governor's Council of Economic Advisors and I advised Governor Inslee.
So you like it?
Well, yes. Yes and no. Yes. Okay, firstly, for those people, listeners that don't know what it is, what it does, it allows the development of multifamily housing inside single-family zoned areas. Now, don't worry, don't imagine you're going to have a single-family house knocked down and a 50-story tower put there. It doesn't apply that way. But it's duplexes up to 6-unit buildings, but also very much dependent upon population as well. So smaller counties, no, you can do duplexes, that's it. Closer to mass transit, you can do denser and larger development. So what it means is the goal was to add supply, right? Yeah. Freeing up potentially more land. Well, a couple of things have happened. One, it was never going to be a panacea. Why? Because in a lot of markets, we're already built out, meaning, well, where are you going to build? There's no free land if it's zoned residential. So what that means is you've got to buy maybe a couple of single-family homes, tear them down, and rebuild them. Oh, remember what we talked about, the price of King County? So let's say you're paying almost $2 million to tear them down to rebuild. No, it doesn't make financial sense. So again, it was not going to solve everything. However, I do expect to see more interest in it as we go forward. But at the same time, what I also found is it's kind of interesting. I always think here, certainly in Western Washington, we're somewhat liberal. And we want housing for everyone. And that's true. But when this bill passed and was signed into law, I realized that an awful lot of people didn't like it. They're like, oh, no.
Why is that?
Why build your cheap housing somewhere else? Don't build it next to me.
Not in my backyard.
NIMBYism, right, which I do a different version of that, banana. Build absolutely nothing anywhere near anything. But what it came down to really, it led me to create this phrase, and it's that liberalism ends at the driveway.
Oh.
Think about it, it's true. So I'm hopeful I believe we will see more interest in it. However, it's not going to be the cure-all. It's not going to solve our woes, but without a doubt, we're going to see more and more of that occurring. It is something. But again, the question is going to be, if you do replace it, now, I'll be honest with you, I saw a situation close to where I live. And that was somebody tore down I think it was probably a 14-unit apartment building, replaced it with 13 townhomes. Okay, not a one-for-one replacement, but coming out of the rental pool and into ownership. Okay, you think, okay, that's great. Yeah, but they were selling for $1.4 million each.
Right, so is that really solving?
And it's not, and that's exactly it. So I think that it's something which is a good deal. I certainly supported it. It's not going to solve all our woes across the state, but it is remarkably important. And it's important for lots of reasons. The biggest thing is we continue to add population, specifically international immigrants. We have actually seen a movement out certainly of King County in terms of net migration, meaning people have been moving away. However, they've been more than replaced by international migrants moving in. And there tends to be a greater propensity for homeownership, multi-generational housing, these kinds of things. So as long as we keep on growing, if we're not supplying enough housing, that continues to push prices higher. Therefore, affordability drops. Home ownership rate is low, which it already is. And that's a problem for companies that are thinking about moving here.
What would you say to just kind of the average person looking to buy a home this year? Any kind of advice for them?
I think the first thing would be, please don't expect mortgage rates to go back to 3%. They're not going to.
Yeah.
In fact, my forecast,
those expectations.
Yeah, my forecast is we'll probably be around 6.5 at the end of the year. We'll be closer to breaking south of 6 by maybe the middle part of next year. But the long-term, what's called the terminal rate for a 30-year fixed-rate mortgage, it's going to be seesawing either side of 6%. Now, that for me I'm okay with it. Why? Because in decades of the 90s, we were at 10 or 12%. In the 80s, we were at 18%.
Whoa.
People still bought housing. Well, the woe part is interesting because millennials never seen a mortgage rate above 5% in their adult lives.
So this is,
So it's a shock. So if they're waiting, don't wait.
Yeah.
But more importantly, I'd say that certainly the desire to own a home is still there. It's the way most Americans create wealth. We know that. But don't over-leverage. I mean, I don't want your listeners, they say, okay, I'm going to buy somewhere. I want them to be able to sleep at night. as they go forward, not be worried about making that mortgage payment. So if it's right for you, absolutely you should. Are we going to see any form of kind of systemic drop in home values, which a lot of people are waiting for, renters? Let's go back to 2008 and drop prices by 30% and I can afford to buy one. Not going to happen. So if it's right, if you can afford it, you find somewhere you want to live in, absolutely you should.
Right. Yeah. Okay. Good advice. Thank you. We're going to switch over into jobs. We talked about unemployment rates and things like that. So what's your take? You posted about the U.S. jobs report that came out for May. What was your take on that?
My biggest thing was the downward revisions. We see downward revisions over the prior 2 months.
Downward revisions.
So the numbers that we saw for April and for March, they go through 2 revisions. And so, because as more data comes in, it's basically more accurate. So we saw downward revisions which took 95,000 people off the number of employees added to the U.S. economy over the course of the last 3 months. That's not a good thing. Most recently, yes, it was positive. It was just north of 130,000. But the problem is a bifurcation there. On the negative side, federal government layoffs. We lost 22,000 people there. But it was offset by what? By leisure and hospitality and education and health. So those are really the only 2 sectors that are continuing to expand. And education and healthcare tends to do that all the time anyway. So it's not a balanced economy. And so I think obviously the federal job losses, DOGE, is the reason for that. We'll probably see more of that. But with healthcare being more than 50% of total US growth, that's not a good place to be when you're overly reliant on one industry sector. And with the 3-month average, about 123,000, it's not horrible, but certainly not good.
Yeah. Let's narrow into kind of Seattle or Washington. Do you have anything to say on jobs here?
It is that we're following a fairly similar trend of a slowdown and a lot of interest right now on the software market and information technology because of layoffs.
All the tech layoffs.
That have been announced. And we've only got data through April. The information sector comprised about 165,000 people, up modestly, but lowest we've seen since 2021. So again, we've seen a slowdown. But there's a subcategory which is software publishing, and that tends to be where everyone should be looking. It's the most important one for us. It is the Facebooks and all these tech companies. There's about 82,000 in the state. That's, again, lowest it's been in 4 years, so not great. King County, it's obviously bigger, as we know. Big tech influence. There's 61,000 in the world. No, in terms of within software publishing, which has come down. I think it's stabilized somewhat. And so in that respect, I think we could see some more attrition, but I think the worst of it is behind us. And there was a lot of worry, quite frankly, is coming out of COVID. And why? Well, companies were laying people off all over the place. We actually saw 1 month of contraction in information software. They kind of kicked a couple of people out and called it good. Then the following month, they started hiring again. So they will continue to hire through 2021, 2022. So they kind of got bloated. And when they get bloated, we've got to cut some of the fat here.
So we laid off a bunch of people in tech, and you're saying, but they hired more, so we're kind of balanced out?
Well, for the tech sector, again, obviously, regionally, in its totality, we got rid of a lot of people during COVID, which we all know that, right?
Yeah, of course.
It only happened for 1 month in the tech sector, literally. 1 month of declines, and then, woohoo, let's go to the races again. So they've really been, again, cutting some of the fat. Also, remote working has had implications as well. I think we could see some more attrition. We've obviously had notifications at Microsoft and layoffs and a few other ones.
So we've been reporting on that. Yeah.
Right. So I think that here's the biggest thing I would say when you come about the worries about tech layoffs. Is the tech sector important to our market? Yes, it is. But please don't believe that these people getting laid off and they're sat at home in their bathrobes eating Cheetos. No, they're getting new jobs. They're doing something else. And so it's a replacement. So you say, oh, no, it's a horrible thing. Well, they're going somewhere else. So overall, I'm not that concerned about it. I mean, they certainly are important here. In fact, they're about 7.5% of total white-collar employment. So it's not insignificant.
7.5% of white-collar employment.
Is in the tech sector. So I think that ultimately they will go, it'll ebb and flow as it normally does. Yeah. But they're not the be-all and end-all. Kind of same thing we saw years and years ago with Boeing, right? When Boeing was growing, we were growing. When they were contracting, we were contracting. And so we kind of went where they went, but we've diversified significantly now. And so there's no one sector that can really say, if this goes down, we may as well kind of lock up the doors and What was that statement? The last person to leave Seattle turned the lights out. That was actually that was a billboard on I-5, which actually the real estate broker put that up back in the early 1970s.
How funny. Okay, thank you. Yeah, that's a good take on jobs. We're going to touch on retail, and then we'll have you kind of give us a looking forward. So I know retail's not your specialty, but you do have a couple stats on retail. So what can you tell us about that, and kind of how people are looking at spending right now in terms of retail?
Well, retail data, we tend to get is tax data, which is somewhat dated, but we've seen a slowdown in fairly obvious parts. So overall retail trade, grocery and convenience stores saw an increase. Why? Well, we know the cost of food. Don't talk to me about eggs. Food and beverage is up. Apparel is actually up a little bit, but drops in construction. No surprises there. New and used cars, significant decline. That, again, not surprising. Building materials, garden equipment. So garden equipment, we still did like $2.4 billion worth of transactions.
Equipment,
yes, we like our yards here in Washington State.
Apparently.
Now, in terms of how we think, and it really kind of goes back to what we talked about earlier on. When we are uncertain, we do nothing. We freeze, we don't buy anything, we squirrel money away. And we've seen that actually nationally, the personal savings rate's gone up, which tends to be what we do when we're just not sure. Same thing applies with our views on going shopping. Obviously, we have to go shopping for food and what have you, but there's those luxuries, and we tend to back off. And because 70% of the US economy is consumption, us buying stuff, if we're not, well, that can slow down the overall economy remarkably quickly. And so that, I think, is what we're starting to see, just that level of uncertainty, level of unease, offset by, wages are still going up. Pretty nice wage growth, actually, here in Western Washington. We're up 4.5% year on year, which is not bad at all, better than the US as a whole. That gives more money in our pockets, but at the same time, rents are going up. If you're a renter, now mortgages, if you've already got one, a lot of people have, that's just fine. But those are looking, and now it's not offsetting the increase in mortgage rates. So I'd say that caution in the entire retail sector is what we're seeing more than anything else.
Yeah. I don't know. Sometimes I do retail therapy when I am overwhelmed and stressed. I'm
don't we
maybe
all?
I'll just buy something and that'll fix my problems. But yes. Okay, so let's look forward a little bit. I know I asked you already about advice for people buying home, but what else should people be thinking about in terms of kind of the second half of the year? What do you see looking forward?
Well, I think, again, it is that level of uncertainty. I'd like to know from the administration exactly if they say they're going to do something, then, okay, do it. Don't change your mind the next day. Because, again, that is that level of uncertainty, which is scary. Soft landing, yeah. I mean, I think that don't expect us to enter a recession.
For people that don't know, what's a soft landing?
Soft landing is the fact that the economy can slow without going into recession. And invariably, what's interesting, again, going back to the Fed, is that historically, when they raised interest rates to solve inflation, they've done it a lot of times. The trouble is they are notoriously bad at it, meaning that they've raised rates and invariably, all bar 2 times, we've gone into a recession. This time, so far, Chair Powell, we've done pretty well. We've stayed out of it. So that would be the soft landing of raising rates and not pushing the US economy into a recession. That, I think, is I expect to see that probably continue. But again, there's an uncertainty. We're not sure from one day to the next what's happening. Look what's happening with Iran and Israel starting yesterday. That's a kind of scary thing as well. The knock-on effects can certainly happen. We've already seen that with oil prices and a few other things. So I think that's there. More than that, I think on the longer-term picture, more people are talking about the impact of AI on jobs. And I'm being asked that a lot now. What does it really mean? And there's some kind of interestingly scary numbers out there. I think Goldman Sachs did a study a while ago, said that globally, 300 million jobs will be lost due to AI. I mean, that's kind of 4/5 of the population of America. So and they're saying 1 in 3 jobs potentially will be lost to AI in the US by 2035 or 2040. Is that a concern? Yes, it is. But at the same time, I would say that we're hopefully going to be going slowly along this road and not jump in like they did in The Matrix, but topic for a different day. And so, I'm hopeful that it will go the way that Bill Gates wants, which is it will help us solve some forms of cancer. Great things about it. But at the same time, we need to be thoughtful about, especially kids going to college now. I mean, will their jobs still be around? Because it will hit entry-level workers. That is no question about it. And I think actually it's going to hit more educated markets more than anything else. So that's going to mean it's going to have a greater impact here, San Francisco, the triangle down around Atlanta. So I think that there's markets which could possibly, over time, be more negatively influenced. So, well, will it, won't it? Again, cautious optimism, but I'm an economist, means I look at the worst possible scenario. And I guess in that case, it would be learn to repair and maintenance. Those jobs won't go away. Communications, jobs that won't go away. So
alcohol sales.
People sales.
Drink when they're happy and they drink when they're sad.
But at the same time, again, I think there's not big worries, but I think roadblocks. But what will slow, I think, that industry down is power consumption. It requires massive. People will say, well, it can't be any bigger than crypto. Hugely so. Unless we can actually figure out kind of basically small-scale nuclear, it's going to be a problem to actually create the power that's needed to run all of AI. So it's not going to take all our jobs away. We're not going to get turned into batteries anytime soon. But that is something which people are starting to talk more about than we've seen. But the last thing I would say in that respect would be, it really kind of combines a number of things we've talked about. Because if we don't fix housing, then unless we've kind of lived on the backs of giants for a century. Meaning what? Well, go back to Bill Boeing, 1917, South Lake Union, and he created that company. We went where they went until the late 60s, early 70s, end of the Vietnam War. But then there were a couple of kids in high school playing around with computers. And we know what happened there.
Yep.
And we kind of rode that wave. And then there was a guy selling books out of his garage. And we know what happened there. Mm-hmm. So unless there's somebody at Bush or at another school now who's going to come up with the latest, greatest widget that's going to allow us to all retire happy, well, we need to attract businesses to move here. Two things businesses look at when they're considering moving or expanding into any market. One is they're a talented workforce. Well, we are wicked smart. Check that box.
We got that.
Right. The other thing is, how much do I have to pay people? And the biggest component of salaries is what?
I don't know.
Cost of living.
Oh, cost of living.
Housing.
Right.
So we check the box on being smart, but the other side of the equation is companies go, well, I've got to pay people how much? So they're not living in a shoebox.
Oh, yes.
Right.
Mm-hmm.
So that is, I think, something which, another reason why housing is so important, not just the fact it's an organic good, we've always needed shelter, but it is the way that households do create wealth. Because if the Fed do a really interesting study every 3 years, which looks at the how much a household that owns their home is worth, what the net value is relative to a renter household. So the median household wealth in America of a homeowner household, it's about $420,000. Median household wealth of a renter household in America, $10,000.
Oh, okay.
Big discrepancy,
so I should
right?
Stop renting. Is that what you're saying?
Well, let me see. Well, the thing is, rents keep on going up. The great thing, the weird thing about actually America is that we have a very unique mortgage situation, meaning that it's a 30-year fixed rate mortgage. So your income over time goes up, your payments don't. Therefore, the share of your income you dedicate to a mortgage payment does what? It goes down. As opposed to Europe or Asia, where it's actually tied to their Federal Reserve, their central banking system. So in essence, it's an adjustable rate mortgage. So we have that benefit. And so you can sit there and over time, live the house long enough, you're seeing appreciation, you're paying down some of that debt, and the share of money you make to pay a mortgage goes down. Wonderful for homeowners, but if you can't get that foot on the first rung of the ladder, you're missing out. And that is the big concern that we could see this generation, not just the second half of millennials, oldest ones, they turn 41 now, so they're getting old. But those in Gen Z after that, well, are they going to see a home ownership rate or have that is matching or greater than their parents? Unless things change, I think it's going to be remarkably hard for them.
Yeah, well said. Well, thank you, Matthew, for sharing all your insights and your data. I really appreciate it. And I also wanted to shout out, we're at Columbia Tower Club. We are at Top of the Tower Studios here, and it's beautiful. We're looking out over Seattle and Bellevue and all the places. It's just incredible out here. So thank you to Columbia Tower Club, and thank you, Matthew, for doing this.
You are very welcome.
This has been The Weekly, with production assistance from Nick Patry. If you liked what you heard, rate us and write a review on Apple Podcast or Spotify. We love listener feedback, so if you have any story suggestions, comments, or complaints, email us at info@theweeklyseattle.com. Make sure to check back next Sunday for the latest local business news. We'll see you next time.